Joining us now to discuss the crypto markets is Fidenza Macro blog author Geoffrey Chen. Welcome, Geoffrey.
Hi, thanks for having me on.
Love you. So things haven't really moved relatively since Fed Chair Jerome Powell used the word disinflation yesterday. No big surprises. The markets really did, at least the crypto markets, that things were a little bit different in the equity markets. But that also happened way after Fed Chair Powell said what he said. Is over this whole waiting, let's hear what Powell's going to say. Let's see what the Fed's going to do. Why? There are no surprises. So where are we going here?
Yeah, in his interview, he didn't really offer anything new, and that's why a lot of asset markets didn't really move that much. In fact, this year I think we're going to see a lot less volatility and uncertainty as the Fed enters the last part of its hiking cycle. They've said that they want to hike to 5.25, and they're probably going to get there. So the move ever since last Friday's non-farm payrolls number was basically just closing the gap between market expectations of the terminal rate and where the Fed thinks they're going to go to. So from here, I actually think that yields and expectations of the terminal rate are going to be pretty stable.
And you also see volumes are kind of going to be not what they were last year. I think you view volumes in 23 that you think that'll be a lot more muted compared to what we saw. Do you ask for crypto or the risk on trade, if you will? Which is it? What do you think is it that there's a lack of enthusiasm for crypto, or do you think is that people are reluctant to take on a risk on trade with higher interest rates?
Yeah, actually, I think sentiment got really depressed last year. And ever since December, we've actually had a number of bullish drivers. We've had China reopen. European energy crisis has kind of abated, and economic data is actually improving in the US, Europe, and in Asia. So things are actually looking a lot better than they were 3 months ago. The Fed is close to the end of their hiking cycle. So I actually think we're in a Goldilocks scenario where the threat of a recession is definitely receding. I don't think we're going to start to, have another economic boom, but we're definitely going to be in the steady state, which is actually really good for risk assets. So in 2019, Bitcoin rallied from 4,000 and did 300% from there, and that was a classic Goldilocks regime in global macro.
All right, so you say Bitcoin and Ether futures on exchanges is nowhere close to the highs reached in 2022. Also, back in January, you posted on Substack about your core view for crypto, writing that we are near the bottom of what will be a multi-year trading range. So just wondering what your expectations are for February and by the end of the year.
Yeah, so, about the volumes on exchanges, I do think a lot of capital has left exchanges, and I do think that people are getting exposure just through spot, unleveraged spot in their self-custodied wallets. And therefore, there's a lot less leverage in the system, which was traditionally, focused on exchanges. I do think that we are in a very large, wide trading range, and we could start to retest the upper end of the trading range. I don't think we're going to break new highs in a lot of coins, but I do think that just by retesting highs in, let's say, Bitcoin or ETH, that's a good 200, 300% from here.
All right. You're also watching the MOVE index, which measures market expectations for bond volatility. What are you seeing there?
Yeah, that's right. So the MOVE index got really elevated last year because bond markets were selling off, the Fed was hiking aggressively, and obviously, bond volatility had to go up. And now that we're near the end of the hiking cycle, the MOVE index is starting to trend lower. And you could see that historically, every time the MOVE index has trended lower, equities have tended to do well. On the bottom there is the S&P 500, and on top is the MOVE index. And every time you see that MOVE index go down, equities go up. And I think that this downtrend in the MOVE index is going to be good for risk assets. And there's a lot of room for that index to go down.
All right, great. Geoffrey, thank you so much for your insights. That was Fidenza Macro blog author Geoffrey Chen.